So this market is what I call a red condition, which means there's probably more chance of it going down than it going up. Now today we had a big day in the market, and Eli Lilly reported numbers and kind of blew away numbers, and the stock is up, I don't know, 9% for the day. So what does that do when a stock goes up 9% in a day on earnings? Well, it's doing it on volume, which is good, and it's also giving us huge amounts of volatility. And when we're in a red market, we want to be more conservative than when we're in a green market, okay? The markets usually go from red to green pretty quickly, but right now when it's red, you want to try to save as much money as you can. It's not all about making all that money. So what we're going to do is look at Eli Lilly. You can see the chart on Eli Lilly. I've got it a little bit covered up here. Let me see if I can, I can uncover it. So you can see Eli Lilly here in a very long kind of consolidation breakout here. And it went all the way up from this breakout at around $800, all the way up to looks like about $965. And then it's had a really bad downtrend for the last few weeks coming into numbers, which is really odd. And then blowing away those numbers and going up and closing just under the 50-day moving average. So a big gap up on energy today, and then going up there and closing right under the 50-day moving average by a little bit, but still, that's a nice big move up. Now, I'm not saying Eli Lilly is going to go up. I don't know. I don't predict stocks. I try to play probabilities, and the probabilities right now are maybe a little bit still skewed toward the downside, even though that was a pretty good report. So here's what we're going to do. We're going to make a covered call on Eli Lilly, and we're going to try to pick up about 1% for a week. Now, 1% for a week is pretty darn good. If you get 1% a week, pretty conservatively, over 50 weeks in a year, that's 50% return. And we're going to do it in the money so that if the stock doesn't go down, we end up making that 1%. Show you what it means. So take a look over here at these options, and you can see that Eli Lilly is at 845.31. And the options right now, I'm going to look at going $15 deep in the money because I think the stock could come back a little bit. Now, I don't always go deep in the money. I highly recommend it, especially for new traders, because you're giving yourself a little bit of protection. And here's the way it works. If you look at these the 830s here, you can see that's $15 deep in the money, but you get $23.90 when you sell those options. Now, obviously, you're not going to get just 23. Look at the difference in the spread, 23 by 28. So you'll probably pick up something in between that. But let's say you're probably going to get a fill in between that. It's crazy that you have $5 spread, but the market just closed, so they're probably just adjusting the end of the day books. But you can see it's $8.90 of juice, right? That's time premium. And if you look right there on the screen, it says $1.05% in juice. That's the return you're going to get as long as the stock stays above 830. The reason we're going deep into 830 is because I think the stock may pull back a little bit. And if it does, that's fine. We're picking up a $23.90 cushion on the way down. So the stock could go all the way down from 845 to about 822. It looks like, or 821, something like that. And if it goes down to that, we still haven't lost any money. It only loses money when it goes below our break even, which is 845 minus 23.90, if you pick up that, what I'm saying there. But the profit is the $8.90. That's the time premium we're getting from being the option seller. And that's 1% for a 7-day trade. So you buy the stock, you sell the call against it, you pick up $8.90 in juice minimum, and you pick up 1%. And that's a 50% per year trade if you could do this trade over and over again, and provided it stays above $830. So that's what we're doing. The market in general has been a little bit weak. And so what we're trying to do is trying to take advantage of being in the market, take advantage of a stock that's just shown some real good promise and may stay up, but it also has a little bit of potential to come back down and fill that gap. And so if it does, we want to protect ourselves a little bit to the downside, and we're going to get about $24 to do that. So I hope that makes sense. See you on the next video.